Now, Kenya has in the last couple of years made significant progress in financial inclusion. A recent report by FinAccess survey, which is released by the central bank, showed that 8 out of 10 Kenyans have access to financial services. Now, of course, that is spurred by the mobile money revolution, which of course has led to increased growth in access to credit services within the digital lending platforms. Between 2016 and 2018, data shows that 86% of loans taken by Kenyans were digital in nature. But this has, of course, come with its challenges and with its successes. With me in studio to discuss more about a new report on digital credit in Kenya from MSC is Anup Singh, the regional head for Anglophone Africa. Thank you so much for making time to have this conversation with us, a conversation that I think is of interest to every Kenyan household based on the data that we have. What informed the decision to have this report?
So we have been tracking the evolution of digital credit sector since 2014. Essentially in 2014 we did our first research, and the core issue was we were trying to understand what is the state of the sector, what are the key personas who are borrowing, what has been their repayment trends, where there were delinquency, what has caused the delinquencies, and what can be done to make the digital credit sector more inclusive, more transformative for the Kenyans. What worries me right now is that still Kenya is about 25 million adults. 2.2 million adults are negatively listed. It's about 8 to 9% of adults are negatively listed. Of that, about 850,000 adults are those who are listed for amounts less than $10.
And that really stood out for me when I looked at the report. Less than $10. What is driving that? What is driving the default rate? What did you read behind that number?
I think one of the reasons why we have seen default at such low values of loan is that people are not really aware about that how is it going to impact. So they basically, in a traditional finance sector, if you don't repay, there will be 2 people, 3 people coming to your house and asking for money. In digital, it doesn't happen that much. It's mostly through SMS because it's a low touch model.
What's the average size of the majority of the loans though, and what is the use? What is the main use of the money?
So in 2016, the average loan was about $36, 3,600 shillings. It has now increased to 4,800 shillings. But if we compare the 3 types of institutions, we compare the banks, the MNO facilitated banks, the likes of M-Shwari, and then the fintechs likes of Branch and Tala. There's quite significant differences in the total amount that they disburse. So banks on an average do about 9,800 shillings or $98. The MNO backed institution do about 4,800, and the fintechs are still at 3,600 shillings or $36.
There's about now 50 fintech companies, but the banks are still dominating the digital space. Just tell us a little bit about that and how it is that the banks are still the bigger player here.
We have to understand that this whole industry, not only in Kenya but worldwide, was started by the collaboration between CBA and M-Pesa, that's Safaricom, which became M-Shwari. So what happened is that when other banking institutions saw that how M-Shwari is doing really great in the market, they also started to kind of innovate around the digital credit and start creating products which are now kind of delivered through the digital channels. And if you look at digital channels, most of the digital channels right now are owned by the banks, so to say, and banks are going into the full-fledged digital transformation. Look at Equity Bank, which is doing 97% of its transaction outside the bank branches. So how are these transactions happening? It's happening mostly through the apps, through USSD, and through the self-service channels that people have. So all of this is basically promoting, and banks already had the infrastructure. They had to create the product, they created the product, came out in the market. They had a good trust and goodwill and brand in the market, which they leveraged and were able to contribute significantly to the digital credit sector.
You mentioned the persona of the borrower, and I just want to take us back a little bit to one of the things that I saw as well in the report about women and borrowing for household. Just tell us a little bit about that.
Yeah, so I would like to talk about 2 key concepts that we have seen emerging from the digital credit sector. One is the concept of digital divide, which we see that there are digital haves and the digital have-nots. I'll elaborate it in a while. And then the second one is on the gender divide. So let's talk first about digital divide. If you look at the fintech applications, these are fintech applications which run on a smartphone, and not everyone has smartphone, although the smartphone penetration has increased significantly. Cost of data is still very, very high. The literacy level, especially in the rural areas, is still, it's not to that mark where people would be technologically savvy to understand the apps and use them. That is creating the digital divide. So what we are seeing is that ultimately digital credit sector is supporting those who have access to smartphones and who already understand how to use technology. But it is not doing enough for those who are at the other side of the digital divide. It is not bridging the digital divide. Coming to the gender divide, if you look at the gender divide, 63% of borrowers are male, which means 37% are female. There's about 36% of gender divide. And if we try to look at why this gender divide is created and what are the ramifications of gender divide, the first and foremost thing that we see is that at this edge of gender divide, women are borrowing lesser amount compared to men. They are because they kind of fear, they are risk averse, and they fear technology, and they fear the constant pressure that would come from the lenders to repay and so on and so forth. So because of that, their utilization of digital credit is also low, and because of that, what they could contribute to the economy is also significantly low.
Yeah. You talked about regulation, and of course this is an issue that has been a sticky point for for a long time, with conversations around the fact that if we introduce regulation, then you put a strain on innovation. It's a thin line. How's it looking like currently, and what are the recommendations on regulation?
I think on regulation there are a few points. We'll have to understand why there are regulations required. First and foremost, there is the issue of data privacy, understanding of terms and conditions, and pricing, and all three are sticky point right now. Pricing, which is supposed to be covered by the interest rate cap, is not covered. Yes. The average,
and I would like us to talk about that in detail in just a moment.
Sure. So if you look at the APRs, the annualized percentage rates of all the loans, it ranges anywhere from 72% all the way to 150%. These are the regulated
compounded on an annual.
Yes. Rate. So these are the regulated entities. If we talk about unregulated entities, there are institutions which have gone up to 621%. I don't know of a business that would earn you enough to be able to repay the loan because the interest rate is just too high. The second point is that I am not told about what all data you are using and how are you using that data. And I don't understand terms and conditions because it's in such legalese language. I don't really understand. And between you and I also, when we basically download a new app, what we do, we just scroll through the TNC as fast as we can.
We don't look at
and we click agree and we go ahead.
Between the lines.
So I think the regulation need to be centered around that, and I would not say that it would be curbing innovation per se. The point is that 7 years ago this product came into market. It came at 7.5%, which is 90% annualized. It's still at the same rate, and everyone is doing it at the same rate. So the whole assumption is that you go digital, you become digital to reduce the cost and then pass on the benefits to the customer. Are the customers getting benefited? The answer is no.
Well, all right. You mentioned the issue of CRB within the report as well, and it is one of the recommendations that the fintechs need to be registered under CRB. Just tell us a little bit about what you think the impact of that will be.
Yeah, so I think there are two recommendations that we talk about with respect to CRBs. One is the data quality and reporting, which is basically that the fintechs need to register them and contribute negative and positive data both. And all fintechs must register and must provide that data. The second issue is about the reporting frequency, which is right now monthly. But in a month, the digital credit sector changes significantly. I can give you an example. Say it is 1st of October and I borrow from one lender and then go to another and third and fourth, and there are 50 plus institutions. I borrow from 15 and none of them have an idea what is happening here. So if there is a real-time reporting from fintechs, from banks, from MNO facilitated banks, I as a lender would get the comfort that I know this borrower, and this borrower has already tried out fintech A, and now he's trying out fintech B and so on and so forth, and he's kind of loan stacking, which is detrimental to his financial health, so to say, his or her financial health, so to say.
So as we wrap up, perhaps just your views on where you see the credit, the digital lending market going over the next couple of years. Should regulation come in? Should they be, under CRB? Where do you see that space getting into?
First of all, we need to start, and the service providers, they need to start thinking about diversifying their product range. Right now, if you look at product, it is basically 1 month, 30 days, and then amount of $40, $30 like that, and at a very high rate of interest. There's no difference when the loan goes to an agriculture household. There's no difference when it goes to a micro and small entrepreneur. So we need to start thinking about the product range.
So this one size fits all isn't working?
It's working, I would say, because people don't have choice, but we can make it more customer centric by providing people with choices. Maybe the loans can go up to 2 months, 3 months, 5 months, 6 months. You are utilizing it as a channel to reach people. There was a development, I think early this year, which was where the digital lenders, the fintechs, they actually came together and formed an association. It's called the Digital Lender Association of Kenya. It's a commendable move because that association is now guided by the code of conduct that they have self-built. So they are self-regulating themselves. The other thing that we also think is that this negative listing right now, the process is that where irrespective of amount you get listed. I think there the regulators can take a call. Maybe what we have proposed in the report is that 5% of gross national income of the country per month is what should be the limit below which you don't list people. Because maybe somebody was trying out the product for the first time and they didn't figure out how to repay, or they forgot about it. There may be any instance like that. So that negative listing burden, that needs to be, that there needs to be a threshold below which you can't negatively list people. Yeah, I think, and one thing also I think is that there needs to be service providers to come together and start gamifying the terms and conditions. And what I mean by that is that you put it like an animated video or something.
So that we can actually read it.
Yeah, or understand it. So it would be like a 1 minute video which you can't skip. You have to go through the whole video. So
Oh, absolutely. Thank you so much for making time to join us to have this conversation. Anup Singh, Regional Head, Anglophone Africa, MSC. Thank you very much.
Thank you so much.